unless you're a Grant Cardone, the money does not flow to you when the deal comes. Unless you have a huge list and you've been doing it for a while, you need to be doing both at the same time. So if you're not able to find deals right now, make sure you're still engaging with your investors.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 431. Many of you know my guest today from the incredibly popular real estate podcast, The Jake and Gino Show. Gino Barbaro has over 2,000 multifamily units and $250 million in assets under management. He's also a best-selling author of 3 books, and with his partner Jake, they've helped their students close on over 68,000 units and $4 billion in deal volume. Gino, you were last on the show in 2018, and it's great to have you back.
Brian, 430 shows plus. That's a lot of chapters. Congratulations on the length, the staying power, and just, committing to it. It's something that is just taken for granted nowadays. People say, oh, you know what, just do a podcast, but you've got 430 episodes. So congratulations to you, brother.
What has that done for you, just having a podcast and having that durability that you've been around as long as you have?
Oh, it's giving me sanity, number one, because when I get on, I talk to other entrepreneurs and they're like, yeah, I don't know what the hell I'm doing. And it makes me feel good because it feels as if I'm the only one that doesn't know what's going on. So that's the first part. The second part is I've been very fortunate and blessed to do a podcast with my wife called the Julia and Gino Show. And that one is like therapy. We've been married 25 years. We've got 6 children. And she's become a life coach because she saw how impactful it was when I became a life coach. And now all of a sudden, we started a podcast 4 years ago, and it's been phenomenal just to get on with other couples, to talk about communication, relationships. I throw in some business because obviously I have to talk business. I can't just talk about family and relationships, but it's a good dynamic there. And I love podcasts personally because I get to spend some time with the host. I get to learn what they're doing in their business. And for me, it's just a great way to make a connection with somebody because real estate, what it comes down to connections. And the more people you know, the more you can spread your word. All of a sudden, somebody might be listening to this, a broker, and 3 weeks from now go, hey, Gino, I saw you on the podcast. I'd love to send you a deal. That's what it's all about, putting yourself out there. And don't worry how bad the first 400 episodes are. You'll get better sooner or later. It just takes a little bit of time. If I go back to my first few episodes, I'm like, wow, I can't even believe I even put those out. But that's part of the learning process. If you're not embarrassed of the first few episodes you've done, then you haven't gotten any better. That's just my personal opinion.
Let's talk real estate. I mean, you've got quite the portfolio. I know last time when we talked, and it was 6 years ago, you weren't doing any syndications. You and Jake were buying and holding yourselves without investors. And I was really shocked by that because everyone that I talked to in this whole, on the podcast and in the business, it's all about syndication, raising money from others. But you had a very different perspective. But since then, I know that it's changed a little bit. So why don't you bring us up to speed?
Well, in 2013, that's when Jake and I closed our very first deal. And the reason why I want to tell you the timeline, it doesn't take 30 years to become successful and wealthy in real estate. If you follow a framework, which is what we call buy right, manage right, and finance right. That's our framework. We bought the first deal in 2013. In that first year that Jake and I started buying assets, we acquired almost 200 units. I mean, it took us 18 months for that first deal, but it took a little bit of time to get traction. But then once we got the first deal, things started moving. We were fortunate to be able to find a partner who had a stronger balance sheet, and we were able to buy those deals with the capital that we had put aside. Now, price points back then obviously were lower. But what we ended up doing was we were continuing our W-2 jobs, and whatever money we were making from the real estate, we were putting it back into the real estate. And after 18 months, we were able to refinance properties out and put that money back in. And what was important when I spoke to you back in 2018, at that point, being in the business and buying our first deal 5 years, from 2013 to 2018, we had probably been able to refinance about between $9 and $10 million at that point. So we hadn't had to syndicate. And then when you hit up against the wall and you start the Jake and Gino community, and like you said, Brian, everyone out there is syndicating. I must be missing something. What am I missing? I'm not a smart dude. Let me go and find out what I'm missing. And I'll tell you, it's a lot of fun to syndicate deals because you start talking to investors. All of a sudden, the opportunity where you can do an $18 million deal that was out of your grasp, you can start doing that now. You can start raising capital. So that very first syndication we did back in 2018, I'll never forget it. It was a great little deal, a great mom and pop, 130 units in Louisville, Kentucky. And we were able to raise $2.5 million in 48 hours. It was something that I never thought would be possible. But the reason why we did it was we wanted to test it and see what the model looked like, be able to teach our students. But also at that point, we were running out of capital. And we're like, you know what, let's start expanding and let's start offering the opportunity to our investors and to our friends and to our family. And after that one, we did a second one, and then we did a third one. After the third one, we said to ourselves, okay, we've got the portfolio here. We're able to continue to refi out more money. We came across a book called Small Giants, and it was written by Bo Burlingham. And I really, from a podcast, and I really enjoyed his concept of we wanted to create an enduring organization. We wanted to create a company with culture, and we didn't need to be the next Facebook of syndicators. We didn't need to have 17,000 units. We decided let's focus on profit per unit, which we target at $250 to $300 in profit per unit. Now, most real estate investors out there, especially the new ones, don't even know what that metric is. But to us, that's a very important metric.
Is that a monthly metric or a yearly metric for you?
That's monthly, $200 every month, $250 profit per month. Now, when you're syndicating deals and you have less equity in those deals, it's a trade-off. You have less equity in the deals, but you're able to scale up and you're able to collect fees, which is great if that's what you want to do. We were like, if we do a couple hundred units a year, and it's our equity, and we're able to control it because we're vertically integrated as well. We have our own property management company, so we can't scale and get 2,000 units a year. We're just going to outgrow our infrastructure. So we made the decision to pause the syndications, but start looking at deals with our own capital. And since then, since 2020, we've been able to acquire probably another 500 or 600 units of our own capital. And that's a decision that we didn't take lightly. We saw that things were getting a little frothy in 2021 and 2022. As you saw what happened with Finance Right, people are buying stabilized deals on bridge debt. And we're like, that's not going to end well. I mean, it just does not make sense to us. And, thankfully for us, we were able to pause it. But for anybody out there looking to syndicate, it's an amazing tool in the tool belt. It is right. You are using other people's money. But remember, you are a steward of their money. It's one thing to lose Gino's money. It's another thing to lose Brian's money in my stewardship. That's something that I take very seriously. And if you're going to syndicate and raise capital, please, first and foremost, learn the business. And then secondly, make sure you have skin in the game. So you're not only putting your investors' capital at risk, you're putting your own capital at risk as well.
What are you doing now? I mean, as we speak, it's February 2020. It's a different market than it was 2 years ago. Certainly a different market than it was 6 years ago. What are you looking for now in the market?
In 2022, we did about 110 units, 3 or 4 small little deals, and it was frustrating. The shiny object. Should we go into RVs? RVs are popping out. Everyone's doing RVs, mobile home parks. And when we looked at our BHAGs, our big, hairy, audacious goal, it was we want to become the Chick-fil-A in the apartment space as far as customer service. So if we deviated, it would have been challenging to do that. But it was so hard, Brian, because everyone else is doing deals and we've only done 100 units. Well, 2023 rolls around and we completed 3 deals, 333 units. We had a stellar year last year. It was phenomenal, great year. All of a sudden, it seemed like the seas parted and these deals are off market. These mom and pops that decided to sell, they sold. So for us, it was phenomenal. A little challenging on the debt side. We used a credit union for the first time in one deal. The other 2 we use community banks. In 2024, everyone coming from NMHC is like, we got to work on operations. Well, shouldn't you have been working on operations since 2000 and 1990? What? And it's one of those things that baffles me. Like, you can do all 3 at the same time. You should be in buy mode, but you really should be focusing on operations. And we've taken on these 300 units plus last year. We've done a lot of renovations. So on the first deal we did, we've got over 100 units returned. So that property is going to come off deck, as we like to say. These 2 properties, we need to focus on operations on these 2 properties. So for us, hopefully, the next 3-4 months, we can just focus on operations and not worry about any deals. But Brian, I really think there's going to be opportunity in this market. I mean, a lot of debt is coming due. There are a lot of capital calls coming out. Debt may be a little bit challenging going forward. That's why I think seller financing and creative financing is going to be an amazing tool. We've got students doing that right now. But if you're out there and you're listening to this and you're in multifamily or in any commercial, venture in real estate, there's two things you're always doing. You're either sourcing for deals or you're sourcing for capital. If there's no deals right now, start building the brand. Start talking to brokers. Start talking to property management companies. Become an expert in the market that you're in and start building your investor list. Because when that deal comes, the last thing I want Brian to say is, I've got this amazing opportunity, but I got to go raise capital now. It's too late. Unless you're a Grant Cardone, the money does not flow to you when the deal comes. Unless you have a huge list and you've been doing it for a while, you need to be doing both at the same time. So if you're not able to find deals right now, make sure you're still engaging with your investors. Make sure you're creating content out there to make yourself relevant. Make sure you're going to these seminars and to these meetings to be able to meet other people and to be able to talk to investors and build that list of investors. So when the deal comes, you have them there and you can offer them that opportunity.
There's a lot of prevailing thought right now that the deals that you're going to find in 2024 are going to be distressed deals in some way. Like they have the capital calls or their loan is coming due and they're kind of upside down in certain ways. Is that what you were able to find in 2023? And is that what you're looking for in 2024? Or like where do you see yourself finding these opportunities?
It's very interesting. I think people forget that in real estate, we're trying to solve problems. And if you don't have a motivated seller, you're really never going to get a decent deal. That's just the reality. I think we forgot about that because people were throwing these crazy numbers back in 2021 and 2022 with this insane debt. So, I mean, what problems were you solving? That the sellers were getting what they're asking and the buyers were just trying to buy anything. What we did in 2023, the first deal we did in March of last year, the seller just walked in after owning the property for 10 years. It was next to one of ours. He just wanted to sell. And we got a phenomenal price on it. We paid $70,000 a unit. I mean, a year later, the asset's probably worth $140 a door right now. I mean, literally. I mean, the rents, in-place rents at the time were $700. We're at $1,100 for one bedrooms now. We knew that was a phenomenal deal because it was literally right across the street from the same vintage and the same assets we had. Now, you may be saying, why would he keep them so suppressed? It's the mom and pop owner who just doesn't want to get the phone call and says, leave me alone. I'm going to keep rents at this price. So he was just motivated to sell. He wanted somebody that could take the deal down and say, get it off my plate. The second deal we did was $105,000 a unit. Really same issue. Rents were at $750 in-place rents. These are 2 and 3 bedrooms in Knoxville. They're up to $1,200 and $1,300. So the opportunity is there. These are actually beautifully done interiorly. Just the outside just needed a lot of work. And this third deal we did in December was a 96-unit deal. It was coming off a LIHTC contract. So it came off the LIHTC in July. 8 of those units are still on LIHTC leases, low-income housing tax credit leases, but the rest of them, we can go to market. So there's the opportunities. Each single one of those deals had value and it had problems, but on all 3 of them, the sellers wanted to sell and they wanted somebody that could transact. They wanted sort of to keep it, I don't want to say under the radar, but they didn't want their employees to know. They didn't want anyone else to know. They didn't want their people who were working for them to know. So they just wanted a surety of close. And we were very easy to work with. We did what we said. We said what we did. We had our debt lined up with, and we were able to execute on all 3 of those deals.
What type of relationships did you have to foster in order to actually get access to those deals?
That's why I love the Jake and Gino community. The second deal was a student who was wholesaling the deal to us. He's in the Jake and Gino community. So that's why you create the brand. And the third deal was with a broker who's been wanting to do a deal with Jake and myself for the last 6 years. He's been listening to our podcast for years. So it's one of those things where, hey, what does a podcast do for you? You just don't know what it does for you, because what you're trying to do is you're trying to create a connection with the listener. And I think if you're authentic, you're transparent, you're even vulnerable sometimes on the show, people make that connection with you and they want to do business with someone that they like. And if you can create that, it really helps. And I think when you're out there in real estate, you need to get out there and meet all of the brokers in your market. That's the number one priority of any multifamily investor, is go out there and meet every single broker. And oh, by the way, property management companies are a great resource as well to learn. And then get out there, get on podcasts. Don't worry how silly you may look. It's very challenging to get through the noise. But if you do, and you can, get on there and speak about what you're doing, the more people you can reach. You never know who comes across listening to you might say, hey, I want to pick up the phone and work with this person.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat-fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. What else do you tell the students in your community? The broker relationships are very important, but what else are you sharing with them or teaching them that they're taking into the world and buying multifamily and investing in real estate?
We get so confused, and we think multifamily is this confusing thing that, hey, I'm in the single family space. I'm going to stay there. It's comfortable. If a pizza guy, myself, and a drug rep can do it, anybody can do it. Life before Jake, I didn't have that map, that process. When I started investing with Jake in 2013, we figured out it was buy right, manage right, and finance right. So if you break it down, the most important thing that you can do with your buy right is create some type of criteria. Where are you investing? You need criteria in buying, because if you don't have criteria, you're all over the place. You don't know what a deal looks like. And that's what a lot of people do when they get into the space, whether it's single family, multifamily, self-storage. I'm looking for a deal. Well, what's a deal for you? And what part of the market cycle are you in for that deal? When we were buying in 2011 and 12 and early on in the market cycle, older assets were great. Price points were low. You were able to fix them, either flip them or refinance them. As we've gotten higher into the cycle, I want everybody listening to this, what are you specifically targeting? And it does change through the market cycle, but right now, for us, we're looking at hopefully 100 units plus. We'll buy a 25-unit deal if it makes sense, because we can put it in with the rest of our portfolio. We can put it into one of the offices and manage it that way. But size, what part of the market are you looking in? What's the median income are you looking at? What is the vintage? I like 1980s and newer right now, because the newer assets need a lot less CapEx, a lot less deferred maintenance, and we're buying holders. So if we're buying a 1960s asset, well, we're going to hold it for the next 20 years, it's going to be really old. Unless we buy it at a great price point where we can totally reposition it and make it like brand new. But think about that as you're going through your criteria: age, vintage, brick, pitched roofs. What kind of unit mixes? We like 2s and 3s. If they're townhomes, it would be phenomenal if we get townhome style apartments. If we can get garages as well, great. What kind of amenities do you like? Well, if properties come with washer, dryer, hookups, that seems like the in thing right now. So focusing on what the criteria looks like, when you put that together, then you convey that. When you're speaking to a broker, you go, Mr. or Mrs. Broker, this is what I'm looking for. Then they're like, oh, okay, we don't need proof of funds for these people. They understand what they're doing. They're professionals. So when they come across that deal, they can hit you up right away. So that's part of what I would say as far as focusing on the buy right. The finance right, listen, long-term fixed rate financing, we've had to go to community and credit unions on the front end because this bridge debt, 2 years and you're done. If you're not an experienced operator, you need to move fast. And there's two ways you go out of business in multifamily real estate. You either run out of time with this bridge financing, or you run out of money. And it's very challenging. So financing, listen, we've been working with the credit unions and community banks at 5 years, terms with, loan to cost. We're able to get the rehab embedded into the loan proceeds, works really well. And that third pillar, which is the manage, which what we call the wheel of the wheelbarrow, that's in constant motion. Understanding what your KPIs are, working with your property management company weekly, being proactive. For instance, creating property logs for every single property, sending out a weekly pulse of your KPIs every week, understanding that you want to know what delinquencies look like, what vacant unrented looks like, what guest cards and applications look like. So you know if something's lagging, you won't wait till the end of the month. You can address it during the month. Those are just some of the things we focus on. And if you look at, I think, Brian, any kind of real estate, if you're buying single family homes, if you use the framework from that perspective, you need to buy them properly. You need to finance them properly. And oh, by the way, they are a business. You just need to manage them as well. So look at that framework, whether you're investing in any kind of asset class in real estate.
The criteria that you're looking at for what you buy, 1980s and newer, I'm wondering how external factors are now maybe changing that, because you look at the rising cost of insurance. And even here in Michigan, where we're not prone to hurricanes or earthquakes or fires or floods, I'm still seeing an increase in insurance, especially on the 1970s, 1980s or older. I'm not sure what area you're investing in, but you also then have climate change. And, as we speak right now, there's huge floods happening in California. How are you navigating some of the external factors that have really kind of been more recent factors as far as real estate investing goes?
We've been blessed only because we're in Knoxville, Tennessee. So there's not a lot of huge weather events. They'll have hailstorm every 10 or 15 years. So our insurance has gone up, but nothing like we're on the coasts and all. And it's unfortunate, but a lot of that rent growth has been eaten up by the insurance and by property taxes. So what you need to do, underwriting conservatively going forward, make sure that you're underwriting conservatively going forward, which means when you're looking at deals, get an actual quote of what insurance is going to look like today when you take over. Make sure that you do loss runs when you're taking properties over to see what's happened with them as well, as far as what's happened in the property, if they've had any collections or any, what's it called? When you're going out and you're making
delinquencies?
Yeah, exactly. Yeah, I'm just trying to think with insurance, and I'm getting confused with insurance because you're making me nervous because I live in Florida and I have 2 rental properties here, and the insurance here is literally almost tripled. It's just been astounding what's going on. You just need to be able to factor that in. That's why some deals won't pencil out. I mean, literally, some will not pencil out, and you need to make sure that your rent growth is not 10 or 15% in a lot of markets. So when you're looking at these markets, understand the expenses. And that's why I said to become an expert in the market. Know what your expense per unit cost is. And every market is different. And you'd mentioned the criteria. As you going into different market cycles, hopefully asset prices start to retreat. Hopefully the B assets maintain prices, but C's drop. And when you see that, you say, okay, I can buy these older assets because I can put CapEx into them and it's not going to kill my budget. Once you see that start happening, that's when you can start changing your criteria. But for me, it's been a completely different thing. Back 10 years ago, buying as opposed to today, it's been a really different swing, and also using different strategies. Back in 2013, there was seller financing in 14 and 15. And it appears now, as debt's starting to pull back, you're seeing seller financing come into vogue again now, whereas syndication may be a little bit more challenging in the next couple of years, because if you've got investors who are having capital calls, who are hearing bad news about multifamily, who their deals aren't performing, they may not want to go invest in another multifamily or another commercial project in real estate. So syndication may be a little bit more challenging. But then you have other options. You have other opportunities that you can use to get into multifamily.
What are you looking at over the next year, 3 years, 5 years? Where do you see yourself going?
For the multifamily, we just instituted something which I thought was pretty cool a month ago. We had one of these, out of 8 offices, one of our offices had a high percentage of work orders open. And we couldn't figure out why. So we had one of our maintenance leads open up work orders. And now we have all 8 offices and we're tracking work orders. We're having a weekly L10 with a maintenance tech who's leading it, going through that. One of the big Hair Audacious goals is not only to have 95% economic occupancy, but to be able to retain these residents. And one way you do that is by delivering that superior customer service. And the way we think that you can do that is by tackling those work orders that are open, making sure that you're pulling them through, because some offices seem like they're doing amazing and some are lagging. And the ones that are lagging, they may need a little bit more leadership. They may need a little bit more training. There may be a little bit more turnover. So that's what we're focusing on the property management side, as far as focusing on, let's see if we can deliver that service. And how do we do that? Well, the first thing is to retain those residents. And then how do you retain those residents? By delivering that service through maintenance. And maintenance has been challenging the last couple of years because it was hard to hire. It's coming back. It seems like hiring is getting a little bit less challenging. And as far as the Jake and Gino side, the education side, the BHAG for us is to have 1,000 students leave their W-2s by 2030. When we have 119 so far, the focus has always been to empower our students and really to have them become multifamily entrepreneurs. I think most educators out there, they look at the space and go, hey, we're going to teach you to buy these deals and to finance them, but you don't really need to manage them. And you see what's happened. But for us, the managed portion is so crucial. And we want to teach students that come on board, not only buy these assets, but how are you managing them? And if you're not going to create your own management company, that's great. You don't have to. How are you going to hold a third-party management company accountable? And how are you going to work with them to make your portfolio stronger?
Talk a little bit about the Jake and Gino community, and feel free to, plug yourself and, how people can find out more about you and get a hold of you.
I had a revelation a couple months ago. I had never, Brian, really put my finger on why I started Jake and Gino. And if I had to sit here and say, I knew it, I wanted to monetize. That was part of it. But when you take a deep dive and really look into yourself, I was on a podcast with Rene Rodriguez. I think everyone should check him out. He's got a book called Amplify. Amazing coach, speaker. And on the podcast, he told me to remember a memory that I had back when I was between the ages of 9 and 13. And he was talking about, at that point, that's when you start really building your values. And I stopped for a second. I said, I can't think of anything. And he said, just think. And I said, okay, I'm 9 years old. I'm going to work with my father. My father owns a restaurant. And when I get to the restaurant, there's bread waiting for us. And I remember bringing the bread into the restaurant. And I bring it into the kitchen. And I'm with my dad. And my dad's teaching me how to fillet chickens. He's teaching me how to cook on the cooking line. And all I remember is how proud my dad was and how awesome it was to have him in the kitchen and how amazing he was at his job and how I looked at him as a mentor. And I always heard everyone saying, hey, Chef Vito, the food is great. And he was really excellent at his craft. And I took that, I guess, through my entire adulthood. I opened up a restaurant 10 years later. And back in 2007, when I lost my father, he passed away, I was still working with him in the kitchen. And at that point, I had asked myself, am I living his dream or am I living my dream? And when I started Jake and Gino, I just said, let me start it. I want to teach others. I want to create impact in others. And I had realized in that podcast with Renee, the reason why I started Jake and Gino is I wanted to continue his legacy. I loved so much what he did for others, the superior service that he delivered, the food that he delivered, the happiness that he shared, and the fact that he was teaching me and he was mentoring others in the kitchen. I wanted to continue and carry that legacy on with and through Jake and Gino. And I'm like, this is exactly what I want to continue to do for the rest of my life, to continue that platform and to create impact for others. I just never knew how to verbalize that. And I was like, how to make money? Making money is great. The money is the result. If you're really good at all this other stuff and you have a big enough why and you can understand your why, then those tough days make it a lot easier. So for us, we started back in 2015. That was our first podcast. In October of 2015, we wrote the book, Buy Right, Manage Right, Finance Right, the Wheelbarrow Profits book. And since then, the student base has grown. Our students have done almost 80,000 units. They've closed, over $5 billion of transactions. They've raised over $400 million. So it's been an amazing journey for me. And just to be like the guide and just to be able to put students together and to be able to see the transformation in people's lives, to be able to put people together that want to accomplish a goal, to get out of their jobs and to actually not hear the noise, shut the noise off and talk to somebody, not about the weather, not about politics, but about, hey, what's going on in your life? What are you excited about? What's your deal look like? How did you do that seller finance deal? That to me is like what the epitome of Jake and Gino is all about. It's all about that community and all about those relationships and putting people together that want to create great things.
It is interesting, that when I ask you what your 1 year, 3 year, 5 year goal is, it's not to have so many units or take down so many units. It's to create a better quality of experience for your residents through work orders, and then to help so many people quit their jobs and be able to find financial freedom. So that does totally fit with what you just said about your father.
It's interesting, Brian, because I'm stuck with that. Like, people are asking me, what unit count do you want? How much money do you want to make? I don't know anymore, because it's not what's driving me. And I think if you're starting out, when I started out, I had those goals. I had the monthly goals. I know what I want to hit every year. I knew how many students I wanted to enroll. As time goes on and you get more clear on what your journey looks like and how you want to create impact, things do change. And I think if you focus on certain parts of your business that frustrate you and that you think that will help you grow and really achieve that impact that you're trying to create, it gives you a lot more clarity. And once you focus on those things, all of a sudden, things start changing. And then, oh, wow, okay, we made more money. Or we closed 300 more units this year. That's what ends up happening, ironically.
What did they call your dad? Chef Bebo?
Vito, I'm sorry. His name is Vito. So
Vito, okay.
Yeah. When I tell it's sort of emotional still, because to be able to be a grown adult and at the age of 53 to figure out that the reason why you hated the restaurant and you wanted to leave is because he wasn't there anymore. And I had grown up from the age of 8 to 37 years old. I'd worked with him, I want to say almost every day of my adult life. And then one day he's not there. And then it's like, that's the pissing element. It's not that I hated the restaurant. I hated the fact that he wasn't there, that I couldn't work with him. And then being there brought those memories, and then being stuck and feeling as if it was transactional. That was the other linchpin for me. I'm like, okay, I need to create something where I can start creating legacy wealth. I can start creating some type of, passive income for myself. And that's why I gravitated towards multifamily.
Once again, just to tell our listeners how they can find out more about you or get a hold of you, or where would you like them to go?
Just go to jakeandgino.com, and we've got podcasts, we've got blogs. If you want a copy of the Wheel of Our Profits, just email me, Gino@jakeandgino.com, and I'll send you a free PDF copy of our book.
What is your favorite hack or app?
I would say my wife. My wife is amazing. I mean, like I said, she homeschools 6 kids. Whenever I need something, she's always there for me. But I guess my favorite hack in the morning, I'm really trying to get up and I'm really trying to practice gratitude. And as we enter the season of Lent right now, I'm really my goal is to try not to complain. That's what my goal is. If I can give up complaining during the week, maybe on Sunday I can do it, but during the week, if I can give that up, man, my life would be so amazing. That's a challenging one, though. I mean, I'm gonna beat myself up about it, but I'm really gonna try to do that one.
Gratitude and not complaining. I like that a lot. And I'm grateful for you to come on the show today and share all this with us. It was a pleasure talking with you 6 years ago, and I hope we can do it again before the next 6 years.
Thanks, Brian.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIGinvestor.com.